today. Thanks a lot for inviting us here today. The paper's at a great time to receive feedback, so we look forward to your questions and such. So Ollie is at INSEAD. He's an accounting professor. I'm a finance professor at Duke. Go ahead, Ollie, to the next slide. And I'm going to give a brief introduction from a finance perspective, and then Ollie will take over and give a continued introduction as well as the meat of the paper. So in finance, we implicitly assume that accounting numbers are informative. Every time we run a regression with CompuStat, every time we interpret a stock market reaction to some kind of accounting announcement, and yet we don't really know how to prove anything about the informativeness. We just assume it. Let me give you just one example. A recent paper that's getting a lot of publicity by Effie Ben-Malek and Raghu Rajan and a co-author, where they look at secured debt over a century of data, so the early 1900s till modern times. And they notice that there's a lot less use of secured debt now than there used to be. And they make an argument in their paper that the reason is because the quality of accounting information has improved and the numbers are more reliable, so you don't need as much security when you issue debt. Sounds like a logical argument, but they have no way of kind of proving whether that's true or not. And our paper can provide some information along those lines. Even though it's a paper about an event that occurred in the 1930s, we think it still has some relevance and some advantages to the experiment. I'll turn it over to Ollie to continue the discussion and lay out the details.
Awesome, thanks so much, John. Yeah, so as John already talked about, the Exchange Act is still very relevant. And even if you look at lawsuits that are being filed today, most of them are still based on the Exchange Act from back then. So we thought this is an interesting act to study, in particular because there are not that many papers on it, and the papers that are about it are pretty old, with the exception of 2 recent papers, ours and also one from a couple of guys at Columbia. And so we revisited this whole question here. So, but it goes back, of course, to that old question of whether one should mandate disclosure or not. And on the one hand, you have critics of mandatory disclosure regulation, but on the other hand, you also have advocates. And critics generally argue that firms are much better informed than regulators themselves. So firms are much more able to decide which information they should disclose that would be useful to investors or not. Advocates of mandatory disclosure, on the other hand, argue that firms trade off only the private costs and benefits, and they do not take into account spillover effects, for example. So, for example, if my earnings number is a useful benchmark for another firm to write effective compensation contracts, then I will not, as a firm, trade off that benefit because that benefit is not really occurring to me. It's not a private cost and benefit, so that firm might not provide the socially optimal level of disclosure. Then, of course, firms have an incentive to disclose truthfully, and that's just the unraveling result. So critics argue that given that firms have that incentive, why would we need to mandate disclosure? But advocates argue that mandatory disclosure provides a credible commitment device for firms to disclose truthfully. And then lastly, critics argue that even before the Exchange Act of 1934, there was already a bit of private and state regulation about disclosure that was already in place before the Act. But advocates, again, on the other hand, argue that this private and state regulation was generally ineffective and not very well enforced. So this led Lloydson and Wysocki in their review of the mandatory disclosure literature in 2016 to conclude that the net effect of disclosure is generally an empirical question and needs to be evaluated on a case-by-case basis as it changes with a specific provision of the different regulations. And we study one particular regulation here, and that's the Exchange Act of 1934. So in the pre-period, we generally had this rather weak and private state regulation, but then something happened, and that was, of course, the stock market crash of 1929 that ushered in the Great Recession. And at the time, many people believed that this crash was mainly caused by excessive manipulation and excessive speculation that, and this is a quote from the Act here, so that's literally what the authors of the Act wrote in the Act, that caused a contraction in credit, prevented a fair calculation of taxes, prevented a fair valuation of bank loans, and impeded bank lending. So they argue here that this, that basically that theft of information had very real effects here on the economy. And the response was pretty drastic, and that was, of course, the Exchange Act of 1934, and that was the first mandatory disclosure regulation. It mandated also for the first time some form of generally accepted accounting principles. It mandated external audits. It established an enforcement body to enforce the new rules, and that's of course the SEC, and it also established civil liability in these lawsuits. And the result was pretty strict and swift enforcement, and here we have another quote, this time from Daines and Jones, that just gives a couple of numbers here to give a bit of perspective. So looking at these numbers, one has to keep in mind that at that time we had around 1,000 publicly listed firms. And when we see here that within the first couple of years, there were 288 permanent injunctions against firms, and that there were several criminal convictions here, over 400, this enforcement at that time was pretty drastic. So enforcement was certainly not an issue anymore after the Act. The empirical evidence to date about the Act is as follows. So first, researchers generally have found that returns and liquidity do not seem to differ very much around the Act, but return volatility appears to decrease. Second, the default rates of bonds decrease after the Act. Third, there's a negative stock market reaction associated with events that promoted the Act that made it more likely that it would eventually pass. And there's generally mixed evidence on whether fraud was prevalent before relative to after the Act. So the critics generally interpret this evidence as that the Act did not really increase welfare because we do not see a difference in the stock returns before relative to after the Act, but the Act might even have reduced welfare because it might have excluded riskier firms. And that argument is based on these findings on the decreased return volatility and the decreased default rates. Advocates, on the other hand, argue that that reduction in variance is indicative that investors are now more able to value securities properly, so there's less variance, and as a result, there's more efficient resource allocation. Because there's more efficient resource allocation, generally welfare improves. But another quote, this time from Easterbrook and Fischel, there's generally not really good evidence that the Act did anything good, but there's also not really good evidence out there right now that the Act did any harm, so maybe we should just leave things as is right now. We argue that this prior research about the Act suffers from several issues here. A lot of these studies lack a control group, and that is problematic in that time because there are so many events in the 1930s, so many macro events that might confound the results here. For example, also in 1934, you have the Glass-Steagall Act, that's just after the start of the Great Depression, and it's also just before the advent of the Second World War. So there are lots of macro events that could confound the results here. The second issue is that these studies generally just look at unconditional returns. They make statements about informativeness of reporting, but they do not really look at the underlying reporting information when they look at stock returns. And the third issue is that they generally look at very long-run return windows, usually return windows of a year or so, and we all know how noisy returns are. Given that so many things are driving returns here, this again provides a lot of room for other confounding factors to confound the results here. So we try to address each of these problems in our study. So first we follow Benson in 1973, and we split our sample in a treatment and a control group. In particular, we define treatment firms as firms that withheld sales information before the Act, and control firms that voluntarily disclosed sales information even before the Act. And then with the Act, of course, the disclosure of sales information that was one of the provision in the new accounting principles became mandatory. Then second, rather than just looking at unconditional returns, we calculate market reactions conditional upon the underlying earnings surprises. To do that, we have to go back to the Moody's manuals and we collect all that earnings information around that time. And then lastly, rather than looking at these long-run window returns here, we really go back to these older studies, Ball and Brown and others, that have looked around at returns around earnings announcement dates. And here we do the same thing. We go back to the Wall Street Journal at that time and hand collect all that earnings announcement data to really calculate these very short run earnings announcement window return reactions, such that the likelihood that confounding factors might drive our results here should be much diminished. And we estimate the whole, our whole model here using a fully interacted difference and difference model with firm and year fixed effects here. And we have a couple of different specifications. The first one being just the typical ERC specification in Collins and Kothari 1989. And here we have our dependent variable, which we in this case define just as normal returns or abnormal returns. And our earnings news variable, which we interact with our treat and post coefficients, will just be the change in earnings. We also look at a couple of other specifications. In particular, we also look at abnormal volatility and abnormal volume response coefficients. And there we just replace the dependent variable here, the return variable, with either abnormal volatility or abnormal volume. And we replace the earnings news variable with absolute changes in earnings rather than signed changes in earnings, as abnormal volatility and volume are not signed. Volatility or volume can spike when they're either very good or very bad news. So we get rid of the sign by taking the absolute value. And first we just start off with a couple of very simple tests here. And this is also very similar to Ball and Brown 1968. Those are just these perfect hedge portfolio returns here, where we observe what an investor that already knows 10 days before the earnings announcement whether the firm will report an earnings increase or an earnings decrease could earn. And we calculate these cumulative hedge portfolio returns over the pre-act and the post-act period. The post-act period is shown here in the blue dashed line, and the pre-act period is shown in the blue dashed line here, and the post-act period is shown in the red solid line. And we see that even in the pre-act period, there is definitely a jump in cumulative abnormal returns around the earnings announcement date, indicating that even in the pre-act period, earnings announcements were informative to investors. However, that jump in cumulative abnormal returns on these hedge portfolios is much larger in the post period, and that difference is also statistically significant. And we interpret this as evidence that indeed after the act, earnings announcements have become more informative. However, there again, we have that issue that there are so many macro factors here that could drive this increase in informativeness. And we argue, and that makes it very necessary to split our sample into a treatment and into a control group. We also do similar tests for abnormal volume and volatility here. So first we just start with abnormal volatility, and we compute abnormal volatility for every day around the earnings announcements before the act and after the act. Before the act, we show the results here in the blue dashed line again, and we see that abnormal volatility spikes before the act, but the spike is larger in the post-act period, again indicating that earnings announcements have become more informative after the act. But again, there could be these confounding factors, so we need to split into a treatment and to a control group. We find very similar results here for abnormal volume than for abnormal volatility. Pretty much the same design, other than there's abnormal volume rather than abnormal volatility. And this brings us then, of course, to our main result here, to our main specification, again showing the specification up here with our ERC regression. And our coefficient of interest, of course, is the beta-1 coefficient here, the triple interaction term, which will measure the change in ERCs for treatment relative to control firms as a result of the act. And we show that coefficient in bold font here, and we see that in every specification, no matter what the fixed effect combination is, there's this positive significant result here, which indicates that indeed ERCs for treatment firms increase more as a result of the act as ERCs for control firms. And these results are also economically highly significant. So in particular, when you just look at the magnitude of ERCs for treatment firms before relative to after the act, we find that ERCs for treatment firms more than double as a result of the act, which is pretty significant. We also test for parallel trends. So here we just look at how ERCs behave, how the difference in ERCs for treatment relative to control firms behave in the pre-period and in the post-period of the act. And we see that there's generally not a statistically significant difference here in the pre-period, suggesting that the parallel trends assumption is satisfied. Then we have that jump in the difference right after the act turned effective, and then that difference declines over time, which is very consistent with Mark Lang's dissertation, where he looks at the determinants of ERCs, and he finds that ERCs are generally the highest right after your IPO, when investors learn the most about the underlying earnings process. And then after, the ERCs get closer and closer to ERCs of other firms. So we also look at abnormal volume response coefficients. So again, now we have abnormal volatility as our dependent variable, and we have earnings news measured as absolute earnings changes as our news variable here of interest that is interacted with the treat and the post coefficients. And again, beta 1 measures here the change in abnormal volatility response coefficients of treatment firms relative to control firms as a result of the act. And we again see that the coefficient is statistically significantly positive across all specifications. And here we have the log of abnormal volatility and log abnormal earnings, because they're truncated at 0. So you can interpret these results as that abnormal volume response coefficients as a result of the act increased for treatment firms relative to control firms by around 6%, which again is economically large. And here again is the parallel trends test. We do not observe any significant evidence in the pre-period. And then we have that jump in the post-period, and then again, that alignment over time here. So the difference between treatment and control firms becomes smaller. So lastly, we also have these volume response coefficients here. It's the same design again. The only thing that changes is that abnormal volume is now the dependent variable. And again, we have in every specification here, we have that positive effect. It's not significant here when we only have firm fixed effects, but when we have all the fixed effects here, it's statistically significant again. And here again is a parallel trends test, which again indicates that the parallel trends assumption seems to be satisfied. So next, we also look at cross-sectional variation in our effect strength here. And one particular test that is, of course, comes to mind is the strength of enforcement. How does the strength of enforcement differ that effect? And we measure enforcement here following Zimmerman 1988 as firm size. The argument being that, okay, larger firms are more subject to public scrutiny and thereby also to regulatory scrutiny. This is, of course, a very imperfect proxy here, but given data limitations, that's right now what we have. And we find that larger firms indeed, when we look at ERCs, either using returns or abnormal returns as the dependent variable, we find now that that triple interaction term interacted with enforcement, that effect gets even stronger for firms that are larger. And we also do the same thing for abnormal volatility and volume, but there we do not find a statistically significant effect. But the message from this test is basically enforcement seems to increase the increase in ERCs as a result of the act. And then we also look at agency cost. And here we have another rather imperfect measure. In particular, we measure low agency cost as an indicator here that the firm is paying a dividend. The logic following Jensen 1982 being that when firms have a lot of cash flow and they don't pay it out in forms of dividend, that indicates that there might be an agency problem, that managers might be engaging in empire building. And in our sample, that whole free cash flow argument seems to be very valid. So right now, a lot of firms do not really have a lot of free cash flow to spend that they could put into empire building. But back then, in particular in our sample, we only look at NYSE firms. And these firms are all very large. And at that time, loss making was a very rare occasion. So all these firms are highly profitable and have a lot of free cash flow to spend. So this gives us a bit more comfort in our low agency cost measure. And we find that the quadruple interaction term here is negative across all specifications, not significant for abnormal volume, but for all the others, indicating that firms with higher agency costs experience larger increases in ERCs and abnormal volatility response coefficients. Again, indicating that agency cost seems to be a valid mitigating variable here. And lastly, we also look at one particular argument that has been made in the literature, and that is that the main effect of the act supposedly is just that it increased conservatism. So that was an argument, for example, made by Binz in 1969. And if that's true, we would expect that good news should become more informative now, because the threshold requirement of disclosing good news will be higher. So basically, we just create an indicator here again that the firm will report an earnings increase around the earnings announcement date. And then we interact that with our triple interaction term here of interest. And we find that the reaction is not really pronounced. The increase in ERCs or abnormal volatility or volume response coefficients is not really pronounced for firms that are disclosing good news here, which is not consistent with increased conservatism. So we fail to provide evidence here that the Act increased conservatism. And this brings us to the conclusion. So the 1934 Act is arguably the most expansive securities regulation in the United States history. The Act was the first to mandate disclosure and drastically increase enforcement. Prior research generally yields mixed results regarding the Act's efficacy, and prior research suffers from several methodological and data limitations that we try to address in our study. In particular, we improve upon prior research by calculating market responses conditional upon the underlying accounting information over short earnings announcement windows, and we split our sample into a treatment and to a control group. And then lastly, we find that, of course, the informativeness of accounting numbers increases as a result of the Act. And that's pretty much the presentation. Thank you so much.
All right, thank you very much for your presentation. Very interesting paper. So now we will switch to the Q&A session. And the first question is actually from Emmanuel.
Yeah, hi, nice presentation, Oliver and John. Thank you. So just a quick question. I got a few, but I'll start with this one. So given the Act, because I saw on the slide, sort of comprised of many changes, like sort of the introduction now sort of formalizing the accounting standards, I think the requirement for audits, there was new disclosures as well, so new information. Do you have a sense of, or do you not care about sort of teasing out exactly what part did what? I mean, now a lot of the issues when we're looking at, say, IFRS literature, right, the issue is, can you separate the actual change in accounting from the change in enforcement? And here it looks like we have everything sort of going on. So do you guys have a sense of, is it new information? Is it a credibility argument for sort of existing information, or even an investor processing, you know, if you buy sort of the comparability arguments behind this? What's sort of your take on that?
Yeah, should I take it, John? Or do you want to take it? All right, so basically, like we agree, right? Like there's so much stuff that is going on because this was a major regulation that just changed everything, right? And as you pointed out, there are now audits, there's now general accepted accounting principles, there's now enforcement. How do you disentangle that? So I think we can speak to a couple of things here. Like first, when you look at our firms, 98% of them already have audits at that time. They're not mandatory though. So maybe there's something special about mandated audits rather than just voluntary audits, but we don't really have that difference. So maybe there's a difference, but we can't really speak to that. The only thing we can say that all these firms had, pretty much all these firms had audits before already. And then another thing we can talk a bit about is, of course, enforcement, and we do that with the cross-sectional test, and we indeed find that enforcement seems to play a major role here. But to what extent it's about enforcement and about the new accounting disclosures, that is difficult to say.
Yeah, no worries. Thanks.
I'm sorry, I forgot to unmute myself. So the next question is from Sundaresh.
Yeah, I was just curious about your choice of, you know, how to study this. It seems like, you know, when you have the market reaction on the left-hand side, basically there's this assumption of market efficiency, right? I mean, and how efficient was the market back in the 30s? And, you know, I think you also open yourself up to the criticism or, you know, kind of an alternative thing is maybe the market was more efficient in the 20s and they picked up on, the earnings news earlier, which is one reason why, the reaction was muted, right? I mean, because your unexpected earnings variable clearly is, based on, like a time series random walk model, right? So it could well be that, in the 20s, the market was so efficient, they picked up on this information before the announcement. And, after that, for whatever reason, they got lazy. I'm not saying it's possible. Again, the point is, once you use market reactions, I think you kind of open yourself up to, some of these issues. It seems like you can look at the quality of the earnings number a little differently. You could look at, where earnings more persistent after the 1934 Act, for example, right? So, that's what I mean by fundamentals, looking at fundamentals rather than looking at the market reaction.
So do you mean, that's a good idea, to look at the persistence of earnings to interpret what's going on. Are you talking about the, whether the information sort of predicts the future better, or do you mean just sort of the statistical quality of earnings?
That's, the predictability is one of the, kind of quality enhancing characteristics, right? So it's all about being able to predict the future, right? I mean, that's, high quality earnings are more predictable, more persistent. So, one way to do this would be to see if, persistence went up after the act, right? I mean, it's one way to do it.
Yeah, no, that's a great idea. We can definitely do that. One point about the market efficiency here. So I think, that's a very valid point. And I think also when you look at Raghu's book and things like that, there are a lot of people that argue that the market indeed was very efficient already in the 1920s. So we hope to get a bit at that, and tell me if you think it helps with that split into treatment and to control firms, because we hope that, by looking at that, it's unclear why the market should be more efficient for, this one particular type of firm relative to the other. So if the market overall was just more efficient in one period, why would it change? Why would it change for the one group but not for the other group?
Yeah, I mean, doing the difference in difference helps. But all I'm saying is, if you just wanted to get it to, did it improve the quality of the information? Looking at fundamentals to me seems kind of the direct approach.
Yeah, I totally agree. Thank you.
Thank you.
All right, thank you. So the next question is from Francine.
Hi, I'm just curious why go all the way back to the 34 Act, given that you say that was so much going on and so many changes that it's sort of hard, or it might be hard to sort of point at any particular thing in terms of whether there is or isn't a reaction to it. I mean, SOX or even Dodd-Frank have incremental additional information requirements that might be easier to isolate. I'm just curious in terms of your choice of wanting to look at the 34 Act, and if maybe you want to follow up with some of the more recent dramatic regulatory accounting and audit information kind of regulations.
Yeah, so the 34 Act, I mean, it's a good question, and there's no reason not to look at some of those other events and regulations also. To talk about why, some of the advantages we think of the 34 Act, it was kind of a 0-1, a little bit more of a 0-1. I mean, there were some of these other state regulations and such, but not really enforced and very spotty. And so the kind of turning on the switch seems like the place that you might certainly notice effects, and that's one reason we look at it. The second is, and Ali can probably expand on this part, that even though it's true that it was a long time ago, like most lawsuits brought today related to stock market manipulation and such, they're still based on the 34 Act. So I mean, its reach is very long. So it's really not something that happened a long time ago and its effects are irrelevant today. But the effects continue to this day. Ollie, do you want to clarify that or talk more about the?
I know, I mean, totally agree with John. Like the one big advantage is, of course, that this is pretty much the only study that I know of that is able to really look at where you have no mandatory disclosure system before you have another one. So when you look at IFRS or Dodd-Frank, you generally have already a mandatory disclosure system in place before, and then you change something about it. But then you basically adjust the mandatory disclosure system. So we are really now able to look at a voluntary disclosure system that is changing into a mandatory disclosure system. So that's a big advantage. And John's second point, still around when you look at the lawsuit sections of 10Ks and of 10Ks, around 80% of these lawsuits are still based on that act. So it is the foundation of our current disclosure system. And given that the act hasn't been studied so much yet, relative to other acts such as IFRS and Dodd-Frank, we thought it would be interesting to provide some more evidence on this foundational regulation.
So there has been an opportunity to revisit. Yes, it is an old issue. I mean, we're trying to convince you we're not just like a history paper here. But even if we were, it still was an important act that the jury is still out on, in part. I mean, it's not like we're doing anything that fancy, but it's just because in modern times we do things with narrower event windows and common sense sort of thing. So it's an opportunity to revisit this old but important event. Yep.
All right, thank you. Just actually a quick comment on this. I was kind of thinking of something similar, right? You still have some examples of, mandated some disclosures like risk factors, for example, right? That became mandated in 2004, which arguably is also very important, right? So you might want to maybe motivate a little bit your paper with some of the recent things as well. And there are papers on that as well that may help you use their question out. All right, so then next question is from Emmanuel.
Yes, thank you. Sorry, I have my questions scattered throughout here. Just a clarification, apologies if I missed it. It's spoken a little bit in the paper, but I actually just want to see how you guys talk about it. What was the reasoning behind the treatment and control classification with the sales, right? I think it's those that voluntarily provide the sales or the controls, right? And then the treatment was, so.
Yeah, so sales is kind of the one item. So these, when you go back to these initial generally accepted accounting principles, they're not really what we are used to today, right? I mean, when you look at the FASB codification, we are talking about several books. That wasn't really the case back then. When you look at the initial disclosure regulation that the SEC promulgated, it's like around 5 pages. There's not so much in there, but one of the things that is in there is that firms have to report sales, because people at that time thought that was very important. But you're of course pointing to a very important issue here, because whether you report sales voluntarily or not is a choice variable, right? Like there's probably a reason why firms decided not to disclose sales before the act. And we look a little bit into that. So we estimated a determinant model with the determinants such as proprietary cost, liquidity, and things like that that are motivated by prior literature. And we generally find that most of these determinants don't seem to play in, but 2 things seem to be important here. One is that firms, that less liquid firms that are more dependent on capital markets, they seem to disclose sales more often. And firms that report good news, so that report earnings increases, are also more likely to report sales in the pre-period. So there's certainly some choice there, but again, our empirical test, even though that these firms are different, in particular, they're less liquid and they have better news that they're disclosing. Even though that might be the case, we hope that our parallel trends tests that show that the difference in these different variables and these different outcome variables that we are interested in here, that these differences are not really trending in any direction before the act.
Okay, thanks. I might come back to you on that. Let me think some more.
Thank you. Well, actually, let's do the next question. said that his question was already answered before. So the next question is actually from me. So I was going to ask you, I was a little bit surprised by, one of your results about the, E or C, you find that, you have a stronger effect after the act for the bigger firms. And I thought it would be the opposite, right? So basically, when you have bigger firms, you have much more information about them, right? So it definitely, investors are more focused on these big firms, right? And then also basically probably more help for smaller firms where you have more information asymmetry, where maybe you can also the credibility of the financial reports is, and then you have auditors and more enforcement. That's a little bit surprising to me, frankly. Can you just please comment on that?
I mean, you introduced a good alternative hypothesis there, and I don't know why the hypothesis that Ali presented seems to be the one that's detecting the data. But again, kind of relying on the literature, this has been a way enforcement's been interpreted in the past related to firm size. We don't have a good counter argument for why your effect didn't show up in the data. Ali, do you have additional thoughts on that?
Yeah, I think it also is a bit dependent on the sample that we are looking at. So we are really only looking at NYSE firms here. So we are looking at the big firms already. So we kind of look at the big firms and the big firms. So some firms are more present than others. I mean, when you go back around that time, you of course have stuff like American Steel, American Tobacco, or these other firms that are really in the public eye, like the big robber barons firms. And they certainly face a lot more public scrutiny than other firms. So we hope that we kind of get at that with firm size. But again, if there's a better measure for enforcement that is available to us, we would be very grateful for any suggestions here.
I can actually look at, I remember what was the paper, there was a paper that looked at all political costs, and they were using whether the firm has any federal contracts. So that's another kind of proxy for that, right? So, maybe you want to look more.
Do you know where we could?
I mean, I found this very interesting. That's what I'm saying. I would like kind of to, see more of that.
Yeah, no, I mean, there would be, it would be great if we could get data on whether firms have federal contracts. I was just wondering whether whether that data is available somewhere.
Yeah, I'll look for a paper and I'll, send you guys an email.
Thank you.
Ali, I'm thinking when those numbers we cite about there was a certain amount of enforcement. Now, I'm sure those are not just New York Stock Exchange firms, but we could look at, well, if we could recreate those numbers to see where that enforcement occurred. I guess it's endogenous, right? That we're arguing that the big firms would be aware of it, but nonetheless, we might be able to dig into those data.
Yeah, like the site that we brought up there early in the presentation, that is unfortunately not from an academic paper. So like it is from academic paper, but they are basically going to a report that was written at that time. So they didn't really have the data to really estimate that themselves. They rely on that report. So it would be great if we could get that enforcement data. That's for sure.
So, actually, just following up on that, and I got a question anyway. So I think you probably make a valid point, right? I wonder, are the small firms back then really sort of the penny stocks that we see these days? So you might want to try and, do some sort of comparability where you're sort of comparing size back then to sort of, small this day, and make the point that actually back then, if you're listed, you're probably a fairly larger stock anyway, somewhat known by investors if you're listed. So really you're sort of looking at within a group of larger firms, right? The biggest ones would probably have the scrutiny. So your scrutiny argument probably holds up more, because I had the same actual comment as Roman. I kind of thought the side result, I would have thought it would completely go in the opposite direction.
So by the way, just to provide some facts on that. So in this different paper, we have kind of looked at, if you sort firms by decile and adjust for inflation, believe it or not, the smaller decile firms, now I'm talking about New York Stock Exchange firms today and New York Stock Exchange firms back in the 1920s and 30s, the smaller deciles line up amazingly closely. What's really happened primarily in modern times is we now have these mega firms. So there weren't really mega firms as much back in the day. Yeah, there were some really big firms. We've still heard of them today, but not these massively mega firms. So I think small back then is similar. We can use our intuition for small of a New York Stock Exchange firm today. They're not tiny, but they're probably not in the headlines either most of the time. But anyway, just sorry, go ahead.
No, right, yeah. So that's actually kind of interesting. So the small stay the same, but we just don't have the huge, the massive firms that you see today. So the differential is probably not as pronounced, because I think in a lot of the empirical studies using current data, you sort of see a lot of the information of a firm is sort of centered around their earnings announcement. You see that a lot more for smaller firms that don't have this sort of trickle of information because they have the poorer information environments relative to the larger firms. So that was interesting. That actually, I got one last question, then I'll throw it over because there's a few others. So how much of the, well, back then, because I'm not sure what the stats are back then, but how much of the sort of the yearly return is concentrated around these earnings announcements? Because we sort of know from Ball and Shivakumar that you don't see, in terms of the total yearly return, you don't see too much of the action centered around the earnings announcements. I'm just kind of, in the scheme of things, how much of the accounting reports actually kind of matter? Because this is one argument about why they don't, right? So I just wondered what sort of the stats were back then.
Yeah, I don't know, but that's knowable. We can definitely calculate that. So basically, we could look at, I guess it's always, the returns is always a bit tricky, right? Because annual returns can be negative. So, but I guess we can just look at, we can go back to Shiva's paper and things like that and check how they did it. But that's certainly knowable.
Yeah, sort of first principles, it would be interesting to see if maybe more of the return was centered around the earnings announcements back then, which is great for the paper, because then that sort of says, you're picking a time where most of the information is released to the market. So actually it's the act, and getting the stuff right is even more important. Some of the arguments nowadays about does anyone really read the 10Ks and the 10Qs anymore and this kind of stuff is that you just don't see, relative to the total returns in the year, you just don't see that huge amount of action.
Yeah, no, I guess that's great. And I mean, right now we can only really talk about how, these things change before relative to after the act. And, we find these pretty drastic increases. But of course, when there's not much going on around the earnings announcement at that time anyways, then of course, a large increase might still be pretty small. So yeah, that's certainly something we'll check out. Thank you.
All right. Yeah, thank you. So next we have Fabrizio.
Thank you guys for presenting the paper. Very interesting. Couple of comments. One is how do you treat loss firms in the model? Your literature in accounting shows that the coefficient there is supposed to be 0. Not lack of persistence. To what extent were frequent loss firms at that time, and how is that accounted for in the model? Then the second one, more broadly, because I don't know anything about that period of time. For example, when Sundaresh mentioned earlier, look at fundamentals like earnings persistence, in my mind, I was also thinking, why not look at whether analysts are more likely to, forecast, change revisions after earnings announcement in the post-earning period. I have no idea whether there were analysts, how many, is it possible to get any data? I mean, you guys got already some amazing data. So more generally, I think because the setting is so interesting, aside from the diff in diff, just to know more about what was the state of the world back then compared to what we know now, even just for the simple ERC model, what type of controls, we know from the Collins type of, series of papers, market to book, all these things. I mean, how different was it back then? You're focusing on one coefficient and diff in diff, but can we rely on that model in the first place, even before the act, what can you tell us about ERC models, the role of loss firms, and then, about analysts, is there any way to get some data? I think that would be interesting.
So Fabrizio, the last bit, this is a very indirect question, but we've done some other papers on like cash holdings and capital structure over like the whole century of data, not just back in the 30s. And by the way, Ollie and I are trying to gather more earnings announcement data, but it's a real pain in the neck. So we do have more years than just these ones we're focused on, but we're still building that out. But at any rate, it's kind of remarkable how stable some of these regressions you'd run to explain cash holdings or capital structure are, even back in the old days. So I know there's an indirect answer if I understood your question correctly, but some of those basic fundamental economic things that were forces, I guess, seem to have been around for a long time. And so it wasn't like a completely different world back then. We do believe, and we're making an argument that accounting regulation and reporting wasn't as good. But as far as how firms operated, you can kind of maybe think of a 1980s manufacturing firm, whatever your view of that is. A lot of these firms seem to operate that way. But I'll leave it at that. And Ali, you want to tackle how we handle loss firms in particular?
Yeah. So I guess in our sample, we don't do anything special about loss firms. And that is also very much related to the fact that there are pretty much no loss firms back then. So while right now we have, I think, more than around 50% of firms are loss making nowadays, but that just didn't happen very often back in the 30s. And then with the analysts, John already kind of pointed out that a lot of these relations are very stable there. So we've both been reading a lot in the literature and books about the time, and at least correct me if your impression is different, John, but I didn't read much about analysts back then. Yeah. So the whole, I think the analysts that we know today, like the analyst that is typically working for some brokerage firm or investment bank or something, the banks back then are, there are some investment banks like JP Morgan, but most of the banks are commercial banks, and the investment banks don't really seem to employ analysts that report their forecasts in any way to the public. But that's just my impression.
Yeah.
Please.
We can poke around to see, but I've never seen evidence that there was public reporting by analysts. If they existed, it was probably just an internal function, but we can certainly look around.
So we are reading through a lot of these Wall Street journals. So as John mentioned, we are still collecting more earnings announcement dates because we just got interested by that stuff. Once you started with that historical stuff, it's quite interesting how these things develop over time. And so I read through a lot of them at this point, and you don't really see any analyst reports back then in the Wall Street Journal. Maybe that doesn't mean that they aren't there. Maybe they have different vehicles, but they are not in the Wall Street Journal.
By the way, if I'm sure you heard Ollie say it a couple times now, but it is surprising to me that there weren't more loss firms, firms losing money in the 30s. It was the Great Depression, The other thing that's surprising is bankruptcies didn't go totally off the charts like you would think too. We have these stories about people jumping out of windows and things when the stock market crashed. But yeah, there were insolvencies, but it doesn't look like we have just a crazy survivor sample of profitable firms and all the bad firms disappeared. If you made it to be a public firm back then, apparently you had the wherewithal to survive through for the most part, through the Great Depression. Anyway, other questions?
Yeah, actually, I have another question. Have you seen any change in the disclosure themselves, right? So if the intention was to make disclosures more formative, and I understand that there's this basically, they have to be audited, right? So there's that part. But did you see any changes in the fundamentals, or I don't know, that's they have some very old financial reports. Ideally, right? You can maybe even look at the text or this qualitative disclosures. Have you looked at that at all? Have anything changed with respect to what firms disclose?
Yeah, I think that goes back to one of the earlier questions, right? And we haven't done it, but totally agree that's interesting, and we'll look into it.
Yeah, basically. So let's so as today, right? So we have this mandate, right? And let's say now I have to disclose proprietary information. Do you actually see that from disclosing that or not? Right? That's kind of be good to know. Since speaking about the formativeness, right? I guess would be if investors react to something, well, they may react to either these reports being more credible, as you mentioned, or new content. So the question is, do you see new content there, right? That's, I guess, my question. I understand, yes, so you have, just want to do this.
Yeah.
All right, so I think I missed one question from Francine.
Just something to keep in mind, having come from working 5 years at MarketWatch, where I'm looking at young journalists who are reacting to earnings reports either before hours or after hours, and we're writing stories, and there's a tendency to forget that we didn't always have instantaneous news and instantaneous reaction to the news. If you're looking at Wall Street journals, I mean, you have to think about the fact that this was print, that they were on a very sort of constrained timeline to get news that whenever the company produced it was going to then make it to a print edition. There was probably a lag in terms of the market reaction to that information, because let's say the company announced something in the morning, it would make it to the evening edition of and Wall Street Journal was probably only published once a day in the morning. So maybe not until the next morning, then somebody would see, then they would have to call their broker on the phone. And so I don't know if it matters, given the way you're looking at this, but things were different then. And so if you're looking at print as the source of the earnings information, you have to take into account a significant lag in terms of when that information gets into the market for someone to act on it.
Yeah, so you're right. Our tests are kind of a joint test of whatever our hypothesis is combined with the timing of the new, that's actually there. It's a great point, and it wouldn't, given what you just said, it wouldn't have surprised me if we saw reactions occurring more in day 2 or 3 or something. But we do actually see most of it happening really fast. So in a way, that's maybe surprising, but it would
maybe insider. So maybe that's insider reaction. I mean, the immediate reaction is going to be from insiders, not from the public markets. And obviously, the 34 Act tried to, deal with that too, but not as well as we've dealt with it in recent times. So it may have been more insider reaction than public reaction. So
that one would be hard for us to totally refute. I guess I'll just fall back on well, we do have, a control group and a treatment group.
Yeah.
So probably the story would need to explain the different behavior across the groups. But it's a point well taken. The world, even though I just tried to argue that firms weren't completely different animals back in those days, information certainly traveled in a much slower way, I'm sure. It's a good point.
Yeah, and I mean, like, we would love to study this, right? So if we can get to whether a certain trade is an insider trade or not, I mean, the Act is all about investor protection, right? I mean, like all these civil liability, provisions and things like that. I mean, it's really like when you read the motivation section of the Act, like the main intent behind that is really to protect the little guy from insider trading, from, speculators, market manipulators and things like that. So if we could kind of see, whether there's more insider trading before relative to after, that would be phenomenal. We would love to look into that.
All right, thank you very much. And the next question is from Miguel.
Hello, I really like a lot of aspects of your paper. Given that recently I also had another paper or another audit, several papers on new audit regulations trying to ascertain a very similar question, right? Whether a change in certain standard that produces more disclosure has effect on markets. But here, perhaps what will be interesting is to be more specific on what is the main insight of your study. Is it the direction, the magnitude, or the specific assessment of the act, right? Because this is where I guess some critics may say that the direction is hardly debatable, right? What is the null? No effect whatsoever. Now, is it the magnitude? The magnitude may be interesting because if we argue that this act has been one of the largest step-ups in disclosure ever, then the magnitude is important, right? Not just the direction, because the direction, I will say that is known after 40 years of capital markets research that aggregates a bunch of effects. And then if the magnitude is important, it's also good to discuss to what extent this is just a local treatment effect versus a generalizable effect, right? That doesn't, I think that tackling that issue won't detract from your paper, and it's important to head on going to that, right? Because it's easy to take cheap shots and saying, well, why do you do this if we already know? But what is not so easy is to dispel the fact that this has been the most important legislation, still cited in every case. It's still cited in every court issue that talks about disclosure. Still heavily cited by SEC regulations, right? So it's important to go back to that and say, well, perhaps if we're going to issue any more disclosure rules, we need to look at that rule both from the legal perspective and from the academic perspective, right? I don't know if that's a question or perhaps a suggestion, but maybe you can tell us a little bit of what you see exactly the sort of the main takeaway from your paper.
I think there are two. And the first one being is that when you read the literature about the Act, if anything, most of the papers out there, which have written mainly by George Stickler, Benson, and others, most of these papers argue that the Act didn't do anything. They argue that it didn't make anything better. They argue that there's no better disclosure whatsoever. They just look at, okay, there's like now something new. But like when you read these papers, they're literally saying like, okay, now you just exclude like smaller firms from the public markets here. So we are arguing that, okay, like it has been when you look at these studies, people have not really documented a lot of benefits of the Act. So we really try to go in and document one particular benefit here, and that is improved disclosure. So, while it might still be the case that the Act might have made it more difficult for smaller firms to enter, it also made the disclosure more informative, and that is really resolving a dispute in the literature right now. So there are papers on both sides here, but the papers on the side that argue that the Act didn't do anything, there are quite a bit more papers on that side.
That's correct, but it's hardly a sell to say that disclosure doesn't do anything to markets, right? I mean, otherwise, I'm just going to shut my office and walk away into oblivion. I won't do any more capital markets research.
Yeah,
right?
yeah. No. I mean, I'm with you. Like, we are only saying that the Act changed the way disclosure operates, right? So we argue that the Act made disclosure more informative, which is just specific evidence on that particular dispute, which is out there. I mean, again, like people are arguing mainly against the Act there from the disclosure side. And I think also the other reason why the Act here is particularly interesting, which goes back to that overall debate about mandatory disclosure, and John pointed to that earlier. I think this is the first study really that is able to look at the switch from a voluntary to a mandatory regime. So that makes it also, I think, a special setting that might inform over these other studies around IFRS that already have found similar effects that we document, but in a different setting again, moving from a mandatory to another mandatory disclosure environment. But John, you might want to elaborate.
No, that's, you hit it. But it's a great question, Miguel, and we need to, it's, you know, the most important question every paper has to make clear is what is the main insight, and we'll look back at our writing and make sure that we're addressing that. Thank you.
All right, thank you, John, Oliver. Thank you very much for your presentation, for sharing your research with us. And everybody else, thanks for joining, participating, asking questions. If you have any question to John and Oliver, please, or suggestion, please email them. And we will also forward them the chat. And the video of this webinar will be also available on our YouTube channel soon. All right, thank you so much, everyone. Have a nice weekend and stay safe.
Thank you.
Thank you.